Well, thanks very much, Mike. Yeah, let me introduce the speakers or the panel. So we're going to talk about helicopters versus other real assets. So first member of the panel, I'll allow him to introduce himself. It's Ross.
Thank you, Russell Christopher, formerly of Thora Capital. Thora Capital has recently been acquired by ITE Management. Just a brief introduction. ITE is a fund manager with about 10.5 billion of AUM, 250,000 assets spanning across rail, intermodal, commercial aircraft, and helicopters now. Really, in terms of looking forward business, we're basically going to continue to do the same kind of helicopter transactions that we've been doing, but essentially with a much larger captive capital base. So, as I'd mentioned yesterday, if you were here, I'm looking forward to reaching out to all of you and doing more transactions going forwards.
Great, thanks, Ross. And the second panelist.
Me? Yeah. I'm Raphaël Naim. I work at RIVE Private Investment. So RIVE is a French asset manager, and we have what we like to offer to our investors is a diversified exposure to asset leasing. So we do not only helicopters, but we do commercial aircraft, engines, shipping, locomotives, and a lot more assets. So we get to see very different markets, and we've been active in the helicopter business for the past more than 10 years actually, and we very much hope to be in the market for the next 10 years. So that's who we are in a nutshell.
Fabulous, fabulous. Thank you very much. Well, as you can see, there's decades worth of experience up here in the chair, on the seat, on the panel. So we'll just get on with it now. The title, it's helicopters versus other real assets. Well, the inherent value, it can be physically touched or seen. So clearly a helicopter it fits into that category. But what is the difference and how does it compare? So if I just let Russ give his thoughts on that to start with. Russ, do you want to explore that?
Sure. So, as I said, we've been recently acquired by a much larger manager that covers other asset types. And from the short time we've been involved with this new owner, we've started to learn about these other asset classes, and we're discovering that there's actually a lot of similarities in terms of long-term fixed contract leases and strong residual performance, bonus depreciation for investors. There's a number of similarities. The one key difference I've identified so far between helicopters and aircraft generally and rail cars, and to a lesser extent the intermodal assets, is the trending of lease rates. Typically with aircraft, over the age of the life of an aircraft, lease rates kind of trend down in dollar terms. The lease rate factor increases in relation to the value of the aircraft over the life of the aircraft, but generally in dollar terms the lease rate reduces over the life of the aircraft, whereas with rail cars there seems to be more of an inflationary correlation where, for example, with US trade policies as they are now creating an inflationary environment, lease rates are trending up on rail cars, whereas with aircraft, lease rates are driven much more directly by market conditions and the balance of supply and demand going on at that time. Other than that, they're actually very similar from what I can see.
Right, right. I see. So you're concentrating a lot more on lease rates there in that comparison. Are lease rates closely connected with the market value of these assets, particularly in the helicopter?
Sorry.
So I'm just asking, are they related to? Do you correlate them with the market value of these assets when you're presenting the lease rates?
Yeah, we generally quote a lease rate factor. Yeah, because that's what's important to us as the owner, is our cash yield on our investment. Yeah.
Right, right. So you're suggesting the helicopters is similar in some way to these other real assets we're talking about. There are others which you've mentioned. So
Yeah.
the rail cars.
Yeah, maybe on the. So we're quite invested in the rail business, and actually, so what we like about the helicopter is the long-term leases, the long-term retaining value of the asset. But what we find very nice in the rail business is that basically the lease term are shorter, so we get 2 to 3 years lease term, meaning that you get to you have a natural hedge against inflation that helps you lock inflation every 2 to 3 years. It creates its own issues. You have to hedge your interest rate and everything, but the rail business is quite interested in that regard.
Right, right. So is it sort of safer to tie in lease rates over a shorter period than a longer period? So if you're leasing a helicopter for 10 years, you don't fix the lease rate year one and.
Yeah, we have a few inflation-linked lease agreement in helicopter, but only a few. But again, with shorter-term lease agreement in the rail business, you get a natural exposure correlation with inflation. So that's something we like. But again, our approach is really to be diversified. So each asset type for us has its own merit, and we try to offer the diversification and to mitigate our risk, basically. So yeah, I'd say that in the aircraft business, helicopter suits us very well, but it must come with other exposure to other asset classes.
Would your exposure be sort of limited to a type of helicopter, or maybe usage, configuration, or maybe even area, different particular regions?
So we're mostly invested in OECD countries. I don't think we have. We look at what works for us, so we're not dogmatic about the models. We can look at legacy aircraft. We can look at brand new, as long as the risk-reward balance works for us. So the way we analyze transaction is we look at the transaction in its own segment, and we look at the risk-reward balance in that own segment. So let's say we acquire an AW169. The risk-reward balance is fine. It sits well within the helicopter business. So that ticks one box. And the second box is say, okay, we have limited resources. Now this aircraft transaction, helicopter transaction, AW169 transaction, how does it compare with another opportunity we have in the shipping business or in the rail business? And then is the risk-reward balance as attractive or less attractive? So then when we finally decide to invest in an helicopter, it means that it has ticked the second box as well, meaning that we couldn't find in the market a better risk-reward balance, or this one helps mitigate or diversify our risk. So that's how we approach that. But we have we do not limit ourselves on models or on age or even mission. We look at about everything, quite pragmatic.
And Ross, how does that match with your thoughts? Or you?
Yeah, that's a rational approach, and the same as how we operate. We look at each transaction on its own merit, and we're agnostic to aircraft type, jurisdiction within reason, and we look at the mitigators involved and the economics of the deal, and we we make a decision transaction by transaction. I'm personally not sitting across different asset classes, so I'm not making that decision of rail versus helicopters or small aircraft.
No, we need it's at the investment committee.
Yeah.
But, I get the chance to be doing some transaction in shipping, so you get to see what else in the market you have and what kind of risk you may take elsewhere. And shipping is a very good example. It's a very cyclical market. You have to have the right timing. The assets are not as complex and as valuable, let's say, technically speaking, as the helicopters. So it's more about timing, about locking a long enough charter. Whereas in the helicopter, I guess if you make your asset analysis right, you buy the right asset and you try to find the right lease attached. It's not so much about timing. There's a bit of timing, of course, but it's not so much about timing. It's more about selecting the right lessee, the right counterpart.
Where does the decision come at possibly at a higher level, but where does the decision come for the proportion of finance to be invested in helicopters or into other asset exposure? You talked about exposure, but I mean, what sort of proportion of finance would be invested in specifically aviation or even more importantly, helicopters?
Well, I mean, across a portfolio of different asset types, in fact, even if it's just a portfolio of only helicopters, you're looking at concentration of aircraft type, jurisdictional concentration, currency exposure, exposure to different mission verticals, exposure to individual counterparties or operators, and you're just trying to make sure you don't have an oversized exposure to any of those. And then when you're going across different asset classes, you're going to do the same. You're going to make sure you're not overly exposed to one asset class over another, because you're always trying to diversify.
Yeah.
To manage risk.
Yeah.
Yeah, and I would love to say that it's a purely rational decision making, but there's also a fact to take into consideration is that our clients are the people that put money, and when you have to talk about your portfolio, you have to sell it to them, so they have to like it. So sometimes trends or news help invest in some sectors more than others. So it's been the case for the rail business for the past couple of years, because it gets a lot of support, it's ESG friendly, so it's quite easy, to be honest. But those trends, they come and go, and so that's why we try to have a balanced approach. So sometimes, let's say that the share of helicopter goes up to 40% of the exposure. Sometimes it come down to 20%. It's
okay.
Yeah.
Okay. Does it depend a lot on the global economy or the health of the local economy then, even if there's investment going in at that level?
Well, actually, what we love about helicopters is that those are mission critical assets. So they are a bit less cyclical than other kind of assets you may find. So when you look at shipping, each time the global economy has a hiccup, values of vessel plummets, and whereas in helicopter and the COVID period was very instructive about that.
Okay.
When you meet the mission, there's still a need, and so
that's a good example. During COVID, was a good example of that, where we raised more capital during COVID than the prior round, because people were diverting capital to our strategy away from more correlated strategies, because during times like COVID or other uncertain times, mission critical assets are required regardless. You still need to fight fires, and you still need EMS services and so on. The only part of the market that isn't that is more correlated is oil and gas, of course, which is why we're seeing, which is why it's more difficult to raise capital and debt financing for oil and gas helicopters than the rest of the sector.
Yeah, that's interesting. Now, from what we've heard in the last couple of days, there've been lots of interesting points about helicopter usage, about maybe backlogs and purchasing new helicopters. There does appear to be quite a long wait, a long period in that from the facts and the figures we've received or we've heard. So. Would you agree, or would you have a comment on why are helicopters in fashion? Would you even go that far to suggest they're in fashion, back in fashion?
I mean, the market is certainly warmer now than it was in previous years. I noticed that the bank panel yesterday was pretty full, so that's encouraging. And there have been a couple of other recent entrants into the market with new capital, ITE being one of them. So there seems to be more interest in the sector than there was in the previous handful of years. I think you were mentioning earlier, utilization is up, right? So, yeah. And that's creating a sort of a slight shortage of supply.
Yeah.
There's a longer lead time on new helicopters. So all of the sort of metrics are sort of bolstering values and lease rates for now.
Yeah.
So I guess that's probably part of it.
Yeah, and maybe I think time has passed. A lot of the suffering of the oil downturn are behind us. The market supply and demand balance is much more disciplined, and I think that people are reassured about that for sure. If you compare that again to shipping, so shipping went through the best years of their life over the past couple of years, and still today you have a couple of operators that have orders that represent in aggregate 30% of the overall fleet capacity. And it has to be delivered within the next 2 to 3 years. So it's massive, and those guys keep playing that market share game, which for asset owner is a bit a stupid game, but they keep playing it. And in the helicopter business, so far I think it's reasonably well managed. You have less. Speculative orders. You have a couple of them, but I think it remains manageable. So. Yeah.
Do you think supply is matching demand sufficiently, fairly, dare I say? From what I gather, the OEMs are working flat out and they're producing all they can produce. Then there's an order book and there's people waiting. If you're waiting 2 years for a helicopter, is that right? Is that matching the need? What can you say about that? What sort of comment can you make on that, Russ? What are your thoughts on
that? Well, 2 years is just long enough to create a stronger secondary market.
Okay.
So, I mean, I'm looking at a transaction at the moment where we're doing a shortish term lease to an operator because they need to train on the type. Okay. And it's going to take 36 months for them to get their deliveries.
Okay.
As an example. Okay. So it does create pockets of opportunity and it does support the residual value of the secondary market.
Yeah, it's very favorable to the owners. I can't complain about the situation today. I'm sure our clients on the operating side are less happy about that, but it's true that it creates a lot of opportunities. And
Sure. These are really valuable points. So it really draws together, it puts the jigsaw puzzle together. All these loose parts come in and become active when there's enough action or enough utilization in the industry and enough finance, enough backing. So I mean, all of these points are great, but how does the industry manage the significant pros and cons we have in this particular sector? Because clearly, over the years, it's, well, as has often been said, it's very secular, and there are times when it's great, so it feels good just now. But I think in the not too distant past, it was slightly opposite to that. So utilization was definitely not as high. Maybe the backlog, maybe so how do we manage the pros and the cons?
Again, for us, it's so we love helicopter. We've been here for 10 years, but we don't have to invest in helicopters. So if a year the market is not the right one for us, if the risk balance is not the right one, well, we don't invest. We have other opportunities on other sectors, and that's how we manage basically. And then, if the market is right, we try to concentrate on the best asset classes. Sorry. That's how we manage cyclicality. But again, compared to the biggest players in the market, we do not have to be in the market. We do not have to bid on all the RFPs. When it just doesn't make sense for us, we don't go.
Yeah. Ross?
Well, across the IT portfolio, it's exactly the same. We invest when it makes sense, not for the sake of investing. Obviously, myself and Mark Schechter over there, we're motivated to do helicopter deals, but we're not just going to do deals unless they make sense. Luckily, the market's very active at the moment. We have a robust pipeline. So the market is very active at the moment.
Okay. So back to the title, we've got helicopters versus other real assets. So clearly we all want to see investment in helicopters. We all have that interest in that sector. And we've mentioned how that compares with other real assets. So is there anything else in particular that you could pull out to differentiate between them both? You want to consider other aspects, other particular things that would maybe, others not quite so aware and au fait about the helicopter sector, they might want to question some aspects of it. What is their investment return in investing in helicopters?
I mean, if you look at the different asset types within ITE management, like, for example, rail cars, intermodal containers and chassis and helicopters, they all have actually very similar average economic useful lives. And they're all on long-term triple net leases, and they all have strong residual value performance, relatively speaking, and they all drive fairly high cash yield. They all carry bonus depreciation. They're all mobile assets. You can borrow debt against them. They all behave very similarly. I can't speak to ships, but the relationship between lease rate and it's just the inflationary correlation of lease rates with rail cars is the only thing I've observed meaningfully that is different so far.
Okay.
Well, indeed, you have a lot of commonalities. The security package look like the same. And the reason why we can do different asset classes is for a reason. It's we're not reinventing the wheel each time we invest somewhere. But what's interesting, and especially in the helicopter space, is that it's a technical market. So for us, it has a kind of a barrier to entry with respect to other financial players. You don't get into the helicopters lightly and say, okay, this year I'm going to invest 200 million because I believe in this market. It's quite a technical market. Assets are difficult to transition from one lessee to another. tax-wise, it's much more complex than just a fixed-wing asset on a passenger aircraft. So all those difficulties create opportunities for people that are willing to take the time and learn about the segment. And then once you have that knowledge, I guess it's a very interesting investment thesis. Just have to have the knowledge about it. Yeah.
Okay. I mentioned pros and cons. I mentioned cycles. I mentioned highs and lows, and we all appear to be in a fairly comfortable position just now when we compare to a year ago, compared to 5 years ago, compared to even longer. It's a cyclical area. So I would suggest just now is probably more comfortable than it's been at other times. But what do you see going forwards? What do you say in a year's time, in 5 years' time in particular? But if you're sitting here next year, where do you see the industry? Where do you see the helicopter asset?
Well, to me, I think something that maybe was not mentioned enough is the level of oil price today. I think it's fairly low. OPEC has changed its approach, so now they are bidding against each other to gain market share, and I'm a bit worried that if this goes on for years, you'll have the same effect as when oil is down, and it will affect the projects. It will affect a lot of the industry. So that's my worry. Whether we are at the peak now.
Okay.
There is no the oversupply for sure, so that's not a risk. But yeah, the oil at such price should not last too long, I guess.
Okay, Russ, what are your thoughts? Next year and possibly as far ahead as 5 years, how do you see things?
I think continued inflation, continued upward trend in lease rates, and cost of capital to remain roughly where it is for now. Possibly tariffs to create some disruption to supply chain. So I think things are going to just keep warming up a little bit for a year or two, personally.
Okay, so we're going to stay up there just now. We're going to hang up there for the moment.
Yeah.
It's not really set
until we don't.
Until we don't. Yeah. Well. Fingers crossed. We can hold. Well, listen. The audience, please. You're allowed to ask questions. Use the Slido. Stick something down, and I can ask these experts up here beside me. You don't have to ask me, but you can ask these experts up here beside me, and we'll try and get some answers for you. We've got one up already. Let's have a look. So I can read it down there. Okay, so which holds value best, generally speaking? A ship, a helicopter, or a locomotive? We've got the lot there. So Russell, do you want to go first?
Well, it depends which ship, helicopter, or locomotive.
Okay.
And where it is and what it's doing, and who owns it, and their balance sheet.
Okay, so there's not really a direct answer, but that's a safe one. Yeah. Okay.
Well, in my view, it would be probably locomotive today. The average age of the locomotive fleet is 40 years old. So, yeah.
So sorry, I'm just seeing the next question. Sorry. So let's go. So if you had to choose between heli investment or rolling stock investment with a projected IRR 15%, which would you go for and why? So I think, Russell, you were talking more specifically about...
Well, personally, I would choose a helicopter because I understand them better.
Yeah.
Put simply.
Yeah.
No, and on our side, I think it will all depend on the risk attached to the transaction. So if it's a 15% IRR on a highly liquid helicopter with a long contract with a decent operator, it's great. Then if you're talking a 2-year stub lease with a risk of renewal and an asset that is aging, I don't know. Yeah, IRR alone cannot make or break a decision. It's IRR coupled with risks. Yeah.
And also back to what we were discussing earlier about what else is in your portfolio.
Yeah,
right.
Exactly.
Okay. Right, here we go. Another question just popped up. So all other things being even, where do helicopters sit from a returns perspective versus other intermodal transport?
Well, the helicopter deals that we do the returns are higher, generally speaking, from slightly higher to a fair bit higher.
Yeah, for helicopter versus locomotive, I would say higher. Versus shipping, the reality is that for shipping, you never know the return you're going to make until you sell the assets. And if you're on top of the cycle, it can be extremely attractive. But it can as well be zero. So
and it's a risk-adjusted thing.
Exactly.
The helicopter market can be a little volatile, and the credit profile of the market, is a broad spectrum, and it's a pretty opaque market. So every deal is very different, and you're operating in different jurisdictions with different kinds of size of balance sheet, and aircraft markets are fluctuating. So there's a lot to manage, and it's so the returns are risk adjusted. They're higher returns because the downside is greater.
The higher the risk, the higher return, almost potentially. So, yeah, okay. Yeah, we've got another question. So how would you compare the availability of finance? So here we go. To the extent that you utilize it for the 3 or 4 asset types that we've discussed so far.
Yeah, so helicopter is probably the most challenging. It's the most challenging, mostly because the assets are, relatively speaking, low-value assets, and so for banks it's difficult, and you have all the scars of the old downturns not helping. So when we do a helicopter investment, for us the most difficult part is getting financing, for sure. In the shipping market, it's extremely liquid, which is surprising when you think about it, because the values are so volatile. But you have a lot of banks out there. It's extremely financial.
Okay.
I think also with helicopters, the deal sizes can be smaller, and I think banks like investing the time to learn about a new asset class to the point where they're comfortable enough to provide financing is an undertaking for them. And I think helicopter transactions are generally smaller compared to what they're used to doing. So they have to decide that it's worth the investment to do that.
I understand it's probably the risk thing that's in there too. Even if a small investment, the risk thing will be still quite apparent. Oh, here we go. Well, this is risk, so yeah, we've got time for this. Which is the bigger credit risk then? A helicopter operator, a ship operator, a train operator?
Well, it depends actually on the lease term. So where we're active in the rail business, we have short lease term. So actually the credit quality is not that big a deal, because when you look at the financials, you have like a good idea that the company is not going to go bankrupt within the next 18 months to 24 months, okay, which is approximately the length of your lease. So you don't have a very detailed credit approach. On the helicopter business, because it's longer term, you have to be more cautious, but you have the underlying projects which help a lot. So again, this would depend on the mission and on the operator. And ship, it can vary. It can vary a lot. Today, if you invest in a container ship, I don't think you'll have any credit issue, because they have accumulated so much money, so much cash, that they actually even don't need you to provide the lease. They'll purchase it themselves. But in downturns, shipping can be pretty rocky.
Okay. Mm-hmm. So if you were sort of put these into an order 1, 2, 3, so the biggest risk is number 1, what order would you put these 3 in? So the biggest risk. What's the biggest risk?
You mean credit?
Yeah. So the biggest credit risk. So you've got helicopter, ship, or train. So what order would you put those in?
I would say biggest is shipping, second helicopter, and third train.
Oh, okay. Helicopter's in the middle there. Russell, how would you sort of judge that credit risk?
I think he's more qualified to speak to that than I am.
Yeah, don't argue. Okay. Are there any other questions? Have we dried out?
Thank you.
There's always one from Mike, but
no, not this time. No.
Okay.
So
fabulous. Well, thank you very much to my panel for contributing. Thank you.
Thank you to Alastair, Fallon and the panel for that session, sadly the last of this conference, Helicopter Investor 2025.